I think this is the first morning I ever realized I've been starting early. That's funny. Well, there's the old phrase, I guess, if you're not early, you're late. But really, I just kind of noticed. No wonder you guys always feel like I'm running away without you. Well, good morning, everybody. What an amazing trading day yesterday. I hope you guys got to take advantage of it. Um, the move that we saw on the Nasdaq was actually big enough to trigger lock limits if it had actually measured distance. It's phenomenal. My goodness. All right, so as usual, a little bumper, get a little out of the way stuff. If you're new to trading, try our courses and our content. We specifically designed it for new traders to help you to answer a lot of your questions and to keep you on track, right? Think of those blow up bumpers that we put on the bowling lanes so that when the kids throw the ball, it stays on the lane. That's why the courses will help you stay on course. It's really easy to get distracted when you're new to trading because there's so many different directions you could take. You see a shiny object somewhere and ooh, squirrel. Well, there you go. Right. So yeah, check it out. Go through the material. Once you're logged into our website, there is a search bar, and that really makes things easier. And the next level training, I mean, I developed well over 90% of all the options material in the next level. Uh, and my goal when I was making it was to fill these videos up with as much content to answer a question as I could. The only real complaint I've ever gotten from the next level is that the videos were too long and were too packed with too much information and people couldn't understand it. So we've been going through and trying to remake those videos, make them smaller, and not put so much information per video, kind of spread it out, spoon feed people instead of drowning them with a fire hose. But yeah, if you're not utilizing this material, either because you're not a member yet or you just haven't come over here and looked at it, if you're a member and you're not using it, then you're not using what you paid for. Yeah. But all right, done with the commercial. So a little bit of perspective on the dollar. It's still kind of just maintaining, although that move off of the low yesterday in the dollar was tied directly to the outcome of yesterday afternoon. Let's see which one I want to bring up. All right, so we had that micro double bottom yesterday. I kind of gave a shout out, watch out. We were hitting intraday lows, and that thing flipped the script and started running. And if you notice, it ties in exactly when this all began to move. And it was also right at 11 o'clock, which is one of those additional auctions that I mentioned yesterday. So, when we talk about those additional auctions and we talk about lunch, um, kind of giving that heads up of look, man, you really need to be prepared for a change in market sentiment that those additional auctions can completely change the day. Well, this is exactly what we're talking about here, right? That move in the market all began right at 11 o'clock. The clock is one of the most powerful tools that you can have. It is the second best indicator that exists. If you're thinking, well, shoot, I want the first one. What's the best indicator out there? Price action. So for today, we got retail sales 8:30, 10, and I mean, it's got the rig count at 1 o'clock, but I worked on drilling rigs for 20 years, and I can tell you that how many rigs that are in the field drilling has no bearing or impact on our marketplace. It doesn't mean that it's not important, especially if you're trading energy or if you're, dealing with oil futures. It has a purpose. It's just not a date where we're going to look at this time frame and say, "Oh, well, I better be careful at 1 o'clock. We may see a change in market sentiment." Meh, probably not. So 8:30 and 10 a.m. All right. So from that, let's get back out to the big deal. We broke some critical levels in the ES yesterday. 4,500 was our line in the sand. We start getting below that, and things start to turn really nasty out there. That was our last hurrah, and we are below that. If we break the 200, it's game on. Ought to get really fun. Um, I was carrying some 4,200 puts in the ES futures, but closed those out yesterday. Took my money and went home. You know, get your wins while you can. And I'm still holding another one, but it was a part of a spread, so it's a real high put sitting way up here. It's way underwater, and get it rolled out. Careful when you're trading futures puts or futures options. We mainly just sell the puts, but careful with them because you're on the clock. It's only going to get so many rolls before you run out of place to roll. So that 200 is the line in the sand right now, and you can put this daily moving average on your intraday chart so that you'll be able to identify when we do come into contact with that thing, right? Because you kind of do want to know when we're going to hit the 50 or when we're going to hit the 200 daily moving average. So you can see, for an example, back here when we were first trying to break through that 50, that was the 50 off of the daily chart. And you imagine trying to go low at the low here without realizing that you were right against the cement. There was no more low to go because you had a serious level of support underneath you. That would have also been a really great place to try to take a long opportunity. If you'd have known that there was a major moving average right there, if you didn't have it on there, if you hadn't gone out to the daily to start your day and realized, hey, we might hit that 50 today, then you would have missed it. So today we want to say the same thing. Hey, we could hit that 200 today. Now you don't have to have it on your chart all day. You could just draw a line too. Make a little note in the scratch pad. I love that scratch pad. That thing, you scribble a note. There's the 200 period moving average at 44.22. If we come into contact with it, we're very likely going to get at least one first touch bounce play. That's day done right there, by the way. But even past that, if we continue to flirt with it, we're likely to break through it. This is a absolute last line of defense. If we wick below it, it's fine. If we close below it today, well, it could get a little rowdy out there. Now, I'm carrying hedges, so I don't care. The more we fall, the more we make. And if we don't fall, that's okay. I make trade. I got my longs on, right? So either way, I'm going to make money. If we really fall, I'm really going to make money. So I'm kind of cheerleading for a move to the downside. But the really good thing about trading futures, we don't care. It goes down and make money. It goes up, we make money. It goes sideways. Well, I'll just swap to options. I'll still make money. There's always something we can trade as long as we can identify the risk. Hey, go back and take a more broad perspective of the way the market reacts around that 50. First touch. Now look at those first touch plays. Obviously, it was very nasty when we came down and made contact with those levels. The size of those candles, right? So we often talk about how the institutions don't really move, don't really use the indicators, and that's kind of true to a point. They use algos a lot and they want to tell the algo to do something. And usually it's something simple like yesterday's high, yesterday's low, yesterday's close. It's real easy to tell the machine those levels. Well, it's also easy to tell a machine about critical levels like the 4400. So it's not necessarily the point that we could be crossing through the 200 as much as it is that we could be crossing through the 4400 today. They're very close to being in the same spot. It's also a lot about liquidity. The institutions don't buy into a futures contract because they think we're going up today. They don't care about momentum. They don't care about trend. They're not interested in asking, is it going to rain today? They're the rain makers, right? It makes perfect sense. So they're on the hunt for liquidity. And right now, that's where it's at. So be on the lookout for that today. Should we breach it, we should get some interesting results. Remember that lock limits do exist on the futures. We can only move so far before they will trigger and lock the market. We've seen that quite often during the Corona fall. Should the news be even remotely positive and we begin to see a reciprocation into yesterday's levels, we have what we call the failed flag play. Now, at the moment, it has not failed, right? But you snap the channel on the fib, throw it across. This is your basing pattern on that flag. Now, technically speaking, the flag has not failed. It's just a flag. But the longer it goes sideways here, the more likely it is to fail. What we're looking for is, maybe a retest of the low, possibly even a matching low or a lower low, hit the warning center of around 111, and then begin the reciprocation. Now, likely it's going to tie directly in with the news. You got the bonds opening at 8, or excuse me, the dollar opening at 8, the bonds opening at 830. All of that could tie into the move. But either way, we're going to be looking for a move off of the lows, whether we bounce at the 100 or we retest that low and then a move to the upside. We're looking for a break of the base. The target would be back where we came from. And one of the institutional pivot points we would need to deal with is yesterday's value, lowest point in the Globex. Beyond that, yesterday's open. The open is one of the most critical, overlooked pivot points that offer trading opportunities. Uh, I trade this one all the time, and yet I never see anybody talk about it. It's like they just forget about it. There's not very many indicators that mark the open. If you try to use Thinkorswims, they usually mark some kind of open back here somewhere, especially in equities. They'll hit like midnight values. Stupid machine doesn't know what we're trying to do, right? So you just got to just use your drawing tool to snap a line. Where's the open? First touch contact, revisiting the open, you get a lot of trading opportunities. Just like this day back here, look at where the open was. We rallied back up. We hit that open line in the sand, couldn't get past it. Then we had our dump right back down again. I seen it. I trade it. Did you see it? No, you missed it. Well, there's always next time. So that's what we're looking for in an upward move. Should the market not like the economic data today, and the idea that we are going into a weekend, there's a lot of uncertainty on the table. There is this concept in I wish I could name the book, but I don't remember which book it was, that talked about every major market crash that's ever come along, and not even a crash, right? But a pullback is 7%, a correction is 14%, and a bear market is 21% to the downside. Every single downward move in history, other than like a shock flash news event, has always been connected to something that we didn't know. So this talk about Ukraine and supply chain issues and chip shortages and corona, these are all known things. It's very likely going to be an unknown thing that really takes the market down. Because throughout history, it's always been the unknown thing that takes the market down. You really got to ask, what's it going to take to get the institutions to sell? Because they've been heavily, heavily hedged. They're carrying massive amounts of insurance, which means they're not scared and they don't sell. The only reason we're seeing selling now is because of the capital rotation. We've got the hike coming and they want to rotate. It's the only reason they're selling. It's not because they're scared. Controlled chaos is what I called it the other day. So a move to the downside, we will be looking to break through that 200 period daily moving average and begin the process of working our way to the downside. The ADR right now is 1.5%. We've got an expected move, just today's expected move, by the way, with an additional $28 or 28 points, right? So you come in, you look at the all products, and you ask, just for today, what's the expected move? 48 points plus 28 points. We'll just round up for some easy math. Call this 50 points and call that 30. That's an $80 or an 80 point expected move from our current location right this second. It's easy enough. Snap your mouse and move $80, 80 points. There's an 80-point move to the upside. It's a 1.82%. There's an 80-point move to the downside. Now you've got a gauge of what normal looks like. That's our normal expected move just for today. We could easily hit both sides of that and it still would not be considered extreme or unusual. So keep that in mind. If we happen to get a little rowdy, we could double that move. We would still be looking for a first touch play, both at the low of the Globex and again at the 200. It is very likely that if we do tag that 200, that we will get an amazing amount of liquidity and a first touch reciprocation that could propel us all the way back up into the 45 area. I would consider that a very strong dead cat bounce. For the NASDAQ, we are already underneath that 200 period moving average. We touched it yesterday. Look at that beautiful first touch response. And then we broke through it like throwing a brick in water. The scope and speed of the move yesterday, starting right at 11 o'clock. That's a 693 point move from top to bottom. So we don't really have a failed flag here as much as a real ugly inverted head and shoulders. You can consider that it is a flag. You have the pull, there is the base, so it is there. But what really stands out to me is we have a 30-minute inverse head and shoulders. It's an ugly head and shoulders, but it is there. All right. So the good thing about having a pattern on your chart is that you can go in and measure that pattern. 14,900 brings us out of the inverse head and shoulders to its target. Now, a lot of places when it talks about trading patterns says only go half the distance of the measurement. That this would be target 1 and this would be target 2. That makes sense to approach it with a little bit of caution and not anticipate that we could actually make 100% of the move. And if you're trading with more than one contract, then you can kind of fade off in the first blush and then, try to aim for that second one with gains already locked in. Keep in mind that volatility is nothing new in the marketplace, and there is a very simple 1, 2, 3 solution to the problem of how do you trade in this violent market. You reduce the size of the trades that you're taking, you increase your stops, and you increase your targets. If you can't perform one of these three, you're screwed. You can't trade in the higher volatility environment unless you're just really good at flow, right? If you have a flow tool, jigsaw, book map, something like that, you could perhaps attempt to trade in a higher volatility environment. But if you're already trading with just 1 or 2 contracts, yeah, you're screwed. You can't get any smaller. If you're using a small account and you're already using as big of a stop as you're comfortable with and you're not willing to make the stop bigger, yeah, you can't participate, right? And then increasing your targets. If you're not staying in a trade even long enough to hit a 1-to-1 already, then the likelihood that you're going to stay in longer now and actually start getting a farther target profit is unrealistic. So again, you couldn't trade in this environment safely. These aren't mine, by the way. This is like the industry standard normal way of dealing with higher volatility. In the Globex, I generally trade with a 2 point stop and a 10 point target. It's a 5-to-1 risk to reward ratio, and I use 10 contracts. In a volatile marketplace, I use half as many contracts, double the size of the stop, double the size of the target. It's the same amount of capital at risk, same amount of profit that I make on the other end of the trade. Nothing changes in my average daily win loss ratios because I just reduce size. Something to keep in mind. Should things start to get nasty today in the NASDAQ, as we really expect that it's going to get nasty today, we got a first touch play opportunity right around 44,350. We'll use the quarter, not the little extra pennies that are on the end of that. So 14,350 is going to be our downside target today. Should we roll over and begin heading back down? On the rollover and heading back down, take the opportunity to mark yesterday's lowest point. That will be a source of contention. When we get back to that spot, we're likely to see a reaction. Mark today's lowest point, because again, if we get to that point, we're likely to see a reaction. On the move back up, if the news happens to be even remotely positive and we see the NASDAQ start to reciprocate today, keep your eye on where the NASDAQ closed yesterday. It's an institutional pivot point. And then today's highest Globex value, because that's going to be a source of contention. We get past that, keep your eye on the 200 period moving average, which is lined up right at that 15,000 mark. That is now the resistance level, right? And what we're kind of looking at here is a Busby play. When you have support and you have support and you have support, and then that support breaks, very often you see price come back and validate, just like resistance. So at the very least, we're expecting a little bit of an upside move just to validate that resistance that we had broke through, or support, depending on how you want to see it. Continue to keep your eye on the clock today. Watch the bonds, watch the dollar, allow that VIX to assist you in, confirming the move. When we see these breakout plays, if we don't also see a breakdown in the VIX, then it's very likely a head fake. Now, it doesn't always mean that, right? There's going to be times where there's an amazing breakout and the VIX just doesn't do anything. That's par for the course, right? Nothing works all the time. But you should at least have an understanding or an idea that there should be a response in the VIX when we start to see a real trend beginning to develop in the NASDAQ and the ES. Watch the dollar. It was that double bottom yesterday in the dollar, or triple bottom, right at 11 o'clock. We started to see that move, and it was just entirely across the board. If you were a trader intraday, SPY, QQQ, ES, NASDAQ, and you were watching this unfold and you weren't in it, and you kept thinking, I can't get in now, it's gone too far. No, I really can't get in now. It's just really, really gone too far. You missed the entire thing, sat out, and then probably went to try to get into it around 2:30, 2:45, 3 o'clock, thinking you just couldn't take it anymore. Right about the time when it really got wild. I talked about this in the stream yesterday when we were live streaming in the large caps room. There are things that you can look at to validate, is this still something that I can trade? Has it gone too far yet? Can I come in and take a bite of the apple? Or what if it stops you out with profit? You got a little too close with your stop, you're following it down, it stops you out. Can you get back in again? Right? It's the age old question. Can I get back in? Or Hey, I just showed up. Maybe you just got home, you fire up the machine, you see it's unwinding, you want to get a piece of the action. Has it gone too far yet? Fair question to ask. There's a lot of things that you can look at to validate that. It's never going to be 100%, but when you can check the box and answer all your questions, then you've got a strong likelihood of taking the trade and getting the follow through that you're looking for. And if you don't know what those are, we've gone through them. Check the next level library, what we watch and why, because I've gone through them before. Went through them again yesterday, but I've gone through them before. The things that you can look at to validate, has this really gone too far yet? Or could I get a chance to come in and get some of this? Keep in mind, by the way, that while these kind of days can give you an entire month's worth of day done, they're not the high conviction plays that pay the bills. These are like my bragging right trades. We don't do these with conviction. I don't trade that with 10 contracts. Heck no. We're going to be using a new watch list on TrendSpider soon that is using the most liquid options in the last 30 days rather than using anything with quote weekly options, because that list has 600 names and our new list has around 100 names, which means it won't give the errors on Think or Swim like like the 600 list does. But we're going to use TradingView this morning since I don't have the TrendSpider list set up yet. We want to adjust this pre-market change percent. Use a filter since we're looking at 500 names and we don't want 500 names. We want to dial this back to around 100 names. It's kind of hard to hit 100, so just, ballpark it, get kind of close. The color scheme needs to be adjusted a little bit because you can see names that are up like a half of a percent or down a half of a percent or very close to it, and they're still gray. So to adjust the color scheme, you go up to the 1x, change that to something like zero point 0.1. Right now, we got a color scheme that is more responsive and reactive. A little bit of reaction in Google. It did hit that 200 yesterday. Microsoft, IBM, right? We do got a couple of names out there. The trading desk on Schwab is moving around. It's interesting when Netflix got kicked in the face last night, it took Disney and Roku with it. And I noticed specifically that they didn't mention in any of the articles Comcast, which is up this morning. So we do have things that we can focus on. Remember, on days like this, when you're going to find most things down, you're going to have to use your own scanners and your own watch lists to find some bullish opportunities if you're just straight up still looking long. I am a little bit of a perma bull. I do like to go long more than I go short when I'm not in the futures. That doesn't mean I won't go short. Just it's in my heart. I want to go long most of the time. So if you do want to go long rather than short, you're going to really have to lean on your own individual watch list. We have to really be stock pickers today and not lean on the sectors because the sectors are all going to be red. So here we've got the NASDAQ 100 pre-market change percent. We don't need to filter it because it's already 100 names. Amazon's down more than 1% this morning. Tesla's not far behind that. Remember, the FANG names are really important. Yesterday, somebody asked me how it was possible that we had 75% of the S&P, or excuse me, we had over 400 names in the S&P yesterday advancing while the candles were still falling. They said, how is that even possible? Well, if the 4 or 8 biggest names in the S&P are making a move to the downside, then the S&P is making a move to the downside. It doesn't matter what the other 480 names are doing. That's a perfect example, right? So it's like I said the other day, if you want to be able to see that, go in and set a watch list to something like the S&P 100. Once you have that watch list set, put on something like market cap. and then just sort them by market cap. You'll see the biggest names in the industry. And if they're down, it won't matter what the other 180 are doing. Right now, we're looking at the S&P 100, but it still gets the point across. If you try to put the S&P 500 in there, it's just going to give you like think or swim errors, right? Like, oh, you're looking at too many things. Nah, whatever. I guess I already had a market cap in there. We just got to spread it out so I can see it. Yeah, there it is. Apple, Microsoft, Google, Amazon, Tesla, Facebook, Nvidia. That's the top names in the list, right? We're just keeping it above 500 mil. I don't have enough zeros in what I just said, but you get it, right? Those top names on the list, they run the market. So when they are all in sync to the downside, we're going down. It won't matter what the others are doing. So market breadth is an old school indicator. If you want to find that on Thinkorswim, use your drop down menu, go to indicators. These are the old school indicators that we talk about: tick, trend, AD, UVol, DVol, all that good stuff. Advance versus decline. These things were never designed for a marketplace with something like Apple and Microsoft, these monsters. So looking at the NASDAQ, how many names are down at least 1%? Only 10 names. So there's not very many names that are down at least 1%. Netflix is one of them. So we can kind of just discount that one already because it was an earnings move, right? Yeah, whatever. But there's a lot of chip names on here: AMD, MU, right? There's a lot of chip names in here. That's worth digging into a little bit more. And I was going through the chip higher charts yesterday. Surprising. So take a look around in there. If we dial this back, this is down 1%. Well, let's just ask the question about a half of a percent. How many names in the NASDAQ are down at least a half of a percent? 22. That's not bad either. That's not even a that's not even a full quarter of a percent of the 100 names in the NASDAQ that are down a half of a percent. That's not that bad at all. When you're in there, take a look around at the names that you do see in there. See if they're representing anything. Is it a lot of IPO names? Is it a lot of chip names that stand out? Well, what is down in there, and what do they represent? Because that could be your opportunity, right? So taking the other direction, instead of the Nasdaq, we want to go look at the S&P. One of the major distinctions between these two is that the Nasdaq 100 does not have financials in it. So it's really important to understand, especially when you're in earnings week with banks and everything else, that the Nasdaq 100 has no financial representation in it. But the S&P is our way to being able to look at that. 28% of the S&P is down this morning. That's the S&P 100 is down. Bank of America, Goldman Sachs, Berkshire Hathaway, Citigroup, JP Morgan, Visa. You're starting to kind of feel a little bit of you see where I'm going with that? PayPal, Morgan Stanley. Yeah, Yeah, you know. Right. So there are a couple of energy names in there. Some odd ones like Lockheed Martin. Texas Instruments is part of the chip sector. I know it doesn't make sense at first blush, but if you run peer group naming, Texas Instruments shows up quite a bit. So it is a part of that chip sector, and it's down as well. So this is a half of a percent. Let's get a little more aggressive and say, well, how many names are down a full 1% in the S&P 100? Just 10. Only 10. Not very many, right? So at first glance, as bad as it felt yesterday, we're not really getting that follow through yet today. And it does make sense because when you see a market that moves very, very far, very, very fast, we very often get that reciprocation, right? almost instinctively because we leave volume nodes behind. So we see that bounce, that dead cat bounce. Everybody, enjoy your morning and have a good day. Be careful and be safe. I will be streaming in the futures this morning, and I will see you all there.